Good morning. Good morning. My goodness, my voice decided it doesn't want to be morning. If you have been following me on social media, you know that when I came back from Texas recently, I was super sick and my voice is still not 100%. But we're here. And it's Friday, and I believe it is for our American friends Thanksgiving weekend. I'm from Canada, so we already had our Thanksgiving weekend a few weeks ago. Wanted to say good morning and hello. I'm going to check and make sure we are live in the Facebook group. If you are seeing this on the internet, be sure to say hi, pop in the comments, say hello, and let me know which platform you're seeing this on. We are live in the Facebook group. So we use a tool called Restream. You've heard me chat about it a little bit before. Everybody say cheese. We are using this tool called Restream that allows us to be live in more than one place at a time. And we do so to be efficient and really optimize the amount of time. So when we were chatting yesterday about visibility in business, it's really important that we are efficient with our time. I was actually doing some content last night and we were looking at the team and I were discussing this, social media can truly become a full-time job, and tracking data could be a full-time job, and pounding the pavement and getting your business name out there can be a full-time job, and ultimately is optimizing some of these pieces and processes so that we can be everywhere. We can track the data, we can do all the social media, we can do all of these pieces. We also still have time to run our businesses and live life. So, some great content coming out of ours with some great tools. We're starting to share more about the tools that we use to run our agency, as well as, the businesses within our agency. We are a part of so many different businesses in many different industries, and so often are coming across the tools that can truly help optimize things and be more efficient and really scale that success. So it is Friday and our last day together for the data-driven workshop. So the best place, if you have questions, you want to discuss what we have been talking about for the last few days, is to jump inside the Facebook community. So the information is just at the bottom of your screen, and it is called the Service-Based Business Society Facebook community. We also have the Service-Based Business Society podcast, and if you have not had a chance to listen, highly recommend. We had a wonderful episode this week. Super excited about it. We had guest Bree Sedano from Sheep to Shark on the podcast, and so much value from Bree. And so if you haven't had a chance to listen to this week's episode yet, highly recommend. And go check it out. All right, so we're going to dive in today, and we're talking about our last two metrics. So, we started off on day one talking about what is the data-driven method, why is data important, and it really can be summarized in data provides this confidence. If you go back to early business days, someone in your business journey has said, numbers don't lie. And, here is my thought on this. Numbers don't lie, but you also have to be able to analyze and know what story they're telling you. One data point does not make a story. And so really looking at, what is normal? what is normal for your business. I was recently at the pediatrician with my daughter, who is quite petite. She is tiny. She always has been. And, the comment that the pediatrician had made was, she is still on a growth curve. It's just a smaller curve. It's her own curve. And so it's really the same with your business. You could, excuse me, it doesn't necessarily matter which curve your business is on, so long as it supports your objectives and you know what curve it's on. So you know when something is abnormal or when something needs some additional support or when we need to make a change. So we're going to dive in today looking at the profitability and sustainability portions of the data-driven method. Yesterday, we looked at the first two key areas, which are visibility and scalability. So I'm going to share so we're back in the same templates. These templates are available for purchase. You can get to them by either downloading the book at datadrivenmethod.io, or you can go straight to our website and go to pricing, and then you can download the templates directly from the site. We have all of our service packages, templates, everything is available right on the site, botcher.io, and then you head to pricing, and all of our packages, SEO packages, bookkeeping, mentorship, templates, you name it, you can purchase directly from the website. Same website, you can also book a call to discuss your business. First consult is always complimentary, and we discuss how we can support you in your mission to scale your success. And the other piece that you can also get to on the website, if you go to Tech Stack, you can see all of the tools we recommend along with our bonus collection. So if you purchase any of the products in our Tech Stack through our links up on the site, including Restream, which is the tool we're using to go live right now, you have a collection of bonuses for each product. So they're listed right on the site. Everything from a complimentary setup call, 60-minute setup call with a member of our team, to there's some backlinks, there's some discounts. I mean, it's a good collection of bonuses. So if you are in the market to purchase tech, today is the day, it being Black Friday, and you can also head over there to our site, click on Tech Stack, and see everything that we have going on there. All right, so yesterday we looked at visibility, and we also looked at scalability. And then today we are going down and we are looking at profitability. So when we're looking at profitability, we really want to focus on being able to break things down into smaller pieces. One of the common things that we see in businesses that aren't tracking specific metrics is that they are looking at things in a large scale. And so it's difficult to determine what is working and what isn't when you have everything piled into the same bowl. If you have all of the jobs you do, whether it is, one specific part of your job or another. Say you have a landscaping company that, in one part they mow the lawns, in another part they, build gardens and install, new yards. And then in the winter we have snow removal. And then, in the late fall, early December, we have Christmas light install. And then at, January, we have Christmas light removal. This is an example where this should be set up within your business as different streams of revenue. There's a few different ways to do that. That's an excellent topic for a consult call because I can offer more specific information about your business. But typically we recommend, and this is a fairly generalized recommendation, but you can either track those in separate departments within QuickBooks. You can do different GL categories if you don't have the departments feature, depending on which QuickBooks plan you're on. And so there's a few different ways to do it, but you want to know, being able to break down and look at specific portions of your business. So The very first metric we're looking at here is total sales revenue. So that is the whole bowl of all the revenue put into one place. So that is, back to our example, that is all of this is monthly sales revenue for the entire month. So whether that is, the lawn cutting, the garden install, the snow, this is that super generalized total sales revenue. So if we, now remember, as I spoke about yesterday, these gray cells autofill. So when we're looking now at these gray cells, some of our calculations from yesterday were waiting on this total revenue number. So now we have numbers in each of these gray cells. In the templates, these gray cells auto-calculate, and the way you can tell if they have completed their calculation is they will say TBD or to be discussed in the cell unless the cell has all of the information to complete the calculation, and then they produce a number. So, we've popped in that total revenue number, and now we're just going to take a brief look at our scalability data points that we calculated mostly yesterday. One of the big ones we were waiting for here is our revenue per generator. So quick refresh, what is a revenue generator? These are the people who are working to create revenue in your business. We don't call them employees because they could be a subcontractor, they could be an independent contractor. However you have hired or whatever your arrangement is with these people isn't relevant to these metrics. There is data and calculations to look at the benefit of, an independent contractor versus an employee, but we're not getting into that today. I do have some fantastic templates and calculating sheets for that. So if that's something that you're interested in, if you have independent contractors and employees and you really want to understand the differences between the two, that's something we can chat about in a future workshop, or you can reach out for that template. But we now have our revenue generators, and we're calculating the total revenue divided by the total number of generators to get our revenue per generator. So in our example, we have each generator, because we have 5, and 50,000 worth of hypothetical sales. So that is now $10,000 per revenue generator. Now, when we're looking then to decide how many people do we need to hit our overall sales target, then we can start to break that down. And we can say, okay, if each revenue generator is producing on average $10,000 in revenue, in order to reach my sales target of X, I'm going to need this many revenue generators. Oftentimes, there's a process to someone becoming a full revenue generator by the time you've hired them, onboarded, trained, all of these things. And so, if you need to hit a certain sales target that requires 10 revenue generators in October, this means that we need to be planning for this ahead of time. We could not, show up on October 1st and say, okay, I need my all these revenue generators, where are they? And so, knowing how much each person is going to contribute is important to being able to forecast sales and team requirements. All right. Now we're going to, break that down a little bit further. And we're looking at our gross margin. So gross margin specifically looks at job-related profit. This does not include all of your overhead expenses. We're specifically looking at job-related expenses. So, the cost of those revenue-generating team members, any materials, back to our landscaping example, if you were installing, new gardens, it would be, all of the materials that you need to do so would all be included in the expenses that we're looking at as our gross margin. So gross margin is those job-related expenses and total revenue, and it's brought down into a percentage. So that is our gross margin, is what we are contributing to the business overall. One of the most common things we see when businesses come in, maybe they haven't had any support on bookkeeping, and don't understand the difference between job-related expenses and overhead expenses is we end up with everything kind of bundled together. It just makes it very challenging to know what is working and what isn't. Because sometimes, maybe if your business is new, you could have invested into infrastructure and expenses, overhead, that you are really growing into. And so if you have, say, gone and rented an office space that is on the high end of the budget, but that over the next, 9 months, your business is going to need it, we don't want to be, in that example, if you have this all blended together and we're looking at this as one thing, you might say, oh, my business is not making any money. Oh my goodness, what's going on? But it could just be that in this example, your rent expense is high for the time. That is a specific management decision to, know you're going to need something and say, oh, I'm going to go ahead with this. We're going to need this office. This is the right decision. To do that is a management decision, and that's okay. But we need to be able to look at the data and say, okay, so, our jobs are profitable. Yes, we know overhead's a little bit high right now. Yes, we have a plan for that. It's not about controlling things with the data. It is about knowing and being able to review and analyze and say, yep, that's a management decision. Yep, that's a management decision. And not just allow things to arbitrarily be happening in your business. Okay, so we talked about gross margin. Now we also want to look at the average job gross margin. So this is something that typically, is that next step in your bookkeeping, in your record keeping, is knowing how much profit each job is making. What is the profit margin on each project? There will be fluctuations, business and life. Things don't always go according to plan. And so you'll have these fluctuations and, some jobs will be a little more profitable. Some jobs will be a little less profitable. That's okay. But we need to know what that average is so that we can say, oh, we had, this many great jobs this month and we had a few jobs that didn't go so well. Now let's review those jobs that didn't go so well so that we can learn. That comes back to that point of, the data-driven method. When we're tracking data, when we're reviewing, it allows those learning opportunities to say, hey, what's going on here? What can we do to prevent this from next time? All right, next one, fixed expenses. What are our total fixed expenses? So if your business could not sell a single thing starting tomorrow, what would your expenses be next month? These are the expenses that you committed to. They're potentially on a contract. They are your ongoing. So if you have salaried employees, these would be part of your fixed expenses. If you have, cell phone bills, office rent expense, vehicle lease payments, equipment lease payments, what is your total fixed expenses? These are the ones that you're going to need to cover every single month, no matter what. We need to know what that amount is. We also then, as we're adding expenses to those fixed expenses, we want to make sure that we are not adding expenses that are going to overextend the business and create a cash problem. So especially what we often see is things get busy. All of a sudden we've got lots going on. Things are getting a little hectic. And so the solution is to kind of throw money at the problem. Sometimes in the, looking at customer experience, sometimes we need to throw money at the problem to get things back on track. However, we want to make sure that we're not putting, long-term commitments in for seasonally busy situations. So, back to our earlier example of, putting up Christmas lights in, late November, early December. If this is your business and you've decided, oh my goodness, when we're putting up Christmas lights, it's super busy. We need one more person. Now, if you've hired a salaried team member, are you going to need this February? Or are you just going to be having this additional expense you need to cover each month? And so those are the things we need to be examining as we're adding to those fixed expenses. The flip side of that is, if you are able to keep your fixed expenses fairly standard and not fluctuating, and you're able to grow your income, your fixed expenses become a smaller portion of that contribution. And what's the difference? Well, it's profit. You're putting that money back in your jeans. So always something to keep a close eye on. All right, profit margin. We are here, line 31. Profit margin, now we're looking at that net income. So, what is the total profit margin of the business for the month? Okay, number 32, CEO salary, owner draw. However, this comes back to however you record it in your books, whatever your arrangement is with your accountant in order to reap the best rewards for our taxation purposes, irrelevant to this metric. We are simply looking at what do you pay yourself. However that's recorded, now whether you're in Canada or the US, there's differences, whether you're a LLC or a sole proprietor or a corporation or doesn't matter. Don't get, this is one of those areas where it's really easy to get pulled into the nuts and bolts. Well, is it this or is it that? The question here is, in cash dollars, what are you paying yourself in a month? Not talking about like an added owner perk of, well, I drive the vehicle a little bit here or that mileage or this cell phone. No, money, cash money in your pocket. What do you pay yourself? We need to know and track how much are we paying ourselves, because as your business grows, we need our income to grow as it fits. And we also need to know what that is as a percentage of revenue in terms of, does that fit the business? Is it possible? Is it feasible? And so that's where we should be tracking that. One of the most common things early on in the business is people just take everything and they put it back into the business, and they're not always paying themselves. And at one point, like, that's not sustainable long term. And so we need to make sure that, we are reviewing this, keeping track. Okay, receivables, total money owed to the business. Depending on your business, you may or may not have receivables, but if you offer any terms, so, sending an invoice to someone and then they pay you, something like a retail store would not have receivables, but even if something is due upon receipt, but you send an invoice to someone after, you will have people that won't pay immediately. And so we need to know how much money is owed to the business. Then on the flip side, how much money is owed to vendors and suppliers. So if you have any supplier accounts, any money that is waiting to be paid. Okay, and budget variance. So, it's budget season. If you don't have your budget done for 2023, now is the time. So we're calculating here the difference between budgeted profit and actual profit. Tracking more specifics of budget variances would be part of your month-end procedures. But when we're looking at the data-driven method, really what we're looking for here is, are we on track with being budgeted? And, is it potentially a positive variance? We had someone last year, a client who was 500% over budget on profit. So, when you think over budget, you're like, oh, not good, but they were over budget on profit. So, some specific business decisions, some offerings and whatnot, and overall the variance there was very positive. Okay, let me check and make sure we're good in the group. Any questions, don't hesitate to just drop them right into the comments. Or the best place to connect after the workshop is over is to join the Facebook community. So the Service-Based Business Society on Facebook. You can pop in there, request to join, and I will approve, obviously not while we are on the workshop. So if you have questions in the very short term, you can drop them in the comments of wherever you're watching this video. We're live in a variety of places. So moving on to sustainability. Now, sustainability, often we think about the environment, which is super important. There's been a focus on, green businesses and paperless and whatnot for a number of years. But what we're really talking about here with sustainability is more than the environment, more than green initiatives, carbon footprints, and all of these pieces. We're also talking about sustainability from an entrepreneur perspective. So often we see people really fueled by passion, diving into their businesses and working so hard. I myself work crazy hours in my own business because I love it. I absolutely love what I do. I've always been a person who works lots of hours. But we also need the ability then to say, I'm going to book this family trip and my business is going to be okay. Or, I am super sick. What is the processes? What does that look like? Is it sustainable from a burnout mindset perspective? These are all factors of a business. And as a side note, the other piece to sustainability that we often don't necessarily think about is if you plan to sell your business at one point. And selling your business, potentially something for another workshop, but something you need to be planning about in advance. You really want to be ready to put your best offer to the market when your business goes for sale. But if you have to work, 100 hours a week and be available 24/7 for your business to function, no matter how well it's functioning, nobody wants to buy that. Because nobody wants to work 100 hours. They're not going to buy that problem. What actually adds value and makes businesses attractive for people to purchase is that they run like a well-oiled machine, are, quite reliable. And you look at the numbers, you can look at the forecasts, you can look at the policies, processes, and procedures, and know that it's a sustainable business. There's so much value in those pieces. And so, when we're looking at sustainability, even if you think, I don't want work-life balance, I just want to work in my business, you can also be thinking about, what are the next steps for your business? If you're an entrepreneur, often, we do something for a while, we get, and then we end up selling it and starting something new. That's kind of part of the entrepreneurship journey, the serial entrepreneur, if you will. And so we want to be looking at that. So, one of the things we look at in sustainability is hours utilization. And we're looking at the total billable hours and the total available hours. So when we're looking at available hours, if you have 2 revenue generators who work in the business and they are available 40 hours a week to do so. So now you have 80 available hours. If you are only billing out 60 of those hours, you are underutilized. It's depending on the industry, depending on the type of work you do, utilizing the hours that you have available to you is really often the first step for hiring anyone else. And sometimes it's a matter of, changing job structures. If you have people available 8 hours per day and your average job is 6.5 hours long, that's really tough. Because now you have this extra little piece every single day. And so that, looking at things and optimizing, maybe changing the way that the job is laid out a little bit so that you can utilize that 2.5 hours each day. Those are management decisions that are part of utilizing. Overtime hours. We're not talking about necessarily looking at, specific payroll, this person worked certain, we're specifically looking at those hours from a sustainable perspective. Someone working, overtime all the time because you're shorthanded isn't, reflective of a sustainable process. So we need to look at that. Reporting. How many days does it take to produce month-end reports? So what are month-end reports? We're looking at financial statements. We're looking at any kind of KPI tracking. We're looking at our data-driven method tracking. Typically it should be by around the 15th of the following month. But it really depends on when your credit card bank statements are produced. Some credit cards, they do come out a lot later the following month. And so that can often delay reporting timelines, but it should be around the middle of the month following that you should have your complete set of reports. Invoicing timeline, getting those invoices out. So often when entrepreneurs get busy, they stop invoicing. So now you have this work, you have paid someone to do the work, someone on your team, you've paid for materials, you have not billed the client. You are literally just holding and carrying those expenses. We want to keep those invoicing timelines short. You also allow for people to have kind of that buyer's remorse and, things you always in the best interest to get things invoiced quickly. Service lead time. Okay, we're looking at how long someone has to wait for service. So if you have a business and, every time someone calls that you tell them, yeah, I can get to you in 7 weeks, does that work for your business? Do they often then look and go somewhere else? There's always this balance. We want to be booked out enough that we're not stressing about where everyone's going to work, but not so far out that customers are going somewhere else. So something to track. Expense overages, bank fees, mobile, anything where you're getting dinged for being over capacity. If you think about your traditional cell phone plan, you have, 5 gigs of data, for example, and now you're using 10. So you're paying more for those extra 5. Anytime that we're having these overages, there's really an indication that we need to go and look at the plan because it's no longer serving the business. It's super common with like tech subscriptions, bank fees, cell phone bills, anything like that. Okay, the last 3, system downtime. Sometime in your life you can think of something where you really were pushing something to the max. Sometimes it's a computer, maybe it's a vehicle. A lot of times it's computer systems that you've outgrown and it's like, oh yeah, it's a problem. When I, was going through university, it was, and I worked at a restaurant, it was their computer system was so outdated and they didn't want to invest in a new one. But, without fail, a couple times a month, busy nights, the whole system would crash and the kitchen would be backed up and super frustrating. So, here we're tracking that system downtime because it can help really evaluate when we go to look at replacing something or whether or not, we need to be adding some future budget plans for systems that need replacing. Okay, on the business time. So we work in the business and we work on the business. As general, this is a topic for probably another day. But when we're talking about in the business, typically we're being a revenue generator. It's when someone calls in sick and you have to go and do that job, or if you are a revenue generator in your business and you are still working a lot in the field, you still need the time on the business working on things like this, showing up to workshops like this, calculating metrics, going to those networking lunches, deciding on your marketing plan, making sure your budget is ready for next year. So we have in and we have on. We need to be, as our business grows, we should be working less and less in the business and more on the business. Especially if you're an accidental entrepreneur, the people who are really good at something and it turns into a business, but you maybe don't have business experience or, doing things like business budgets and tracking data and doing all the, if that's not the stuff that you're naturally drawn to, oftentimes we just, avoid and ignore the things that we find difficult and uncomfortable. So we want to be tracking how much time is spent on the business. This is something that you most likely will not have a metric for, you won't have any data for until you start tracking it. And it's just a matter, even if you track it in kind of half days, I spent, 3 mornings I spent in the office this week. And I spent the rest of the time in the field. Okay, that's three half days. It doesn't have to be down to the minute. We really are just looking for that shift of in and on and making sure that it is, growing in proportion with the business scale and size. Okay, last one. Late nights or missed events. These are the total occurrences where business prevented life. Okay, it's the times where you feel like, oh, I had to stay up late and just get this finished. It's the time where you had to cancel family plans because something in the business happened. All of those types of things, they are, the times when it's expected as a business owner, things happen, but it can't happen all the time. It needs to be, the rare occurrence, not the all the time. So we need to be tracking that. That is all 36 metrics in the data-driven method. If you're going to sit down and calculate them start to finish in your business, you most likely could do it in an afternoon for the first time. Some things like the on the business time is something that you're going to have to start tracking. So, implementation recommendation would be to sit down, calculate what you can, know what you need to start tracking, and then implement those tracking methods, and then do nothing for 30 days. Put it on the shelf, and then track again. And then start reviewing and analyzing what the data points mean in your business. So if you have questions, you want to know, and have discussions about what they mean in your business, you can jump on our website and book a call. I am happy to chat through those decisions and discussions with you. Otherwise, jump in the Facebook community and we will chat there. Thank you so much for joining on our 3-day data-driven workshop, and have a wonderful weekend.